Hello everyone, this is John from optionsmeister.com, and my presentation today is on managing an inverted strangle. Before we get started, I want to tell you a little bit about what we do at optionsmeister.com. The vision of OptionsMeister is to educate traders and investors on using known probabilities to become consistent, profitable traders. And the goal is to show every client that successful trading is a learned skill. It doesn't require super athletic skills, etc. like that. It's a learned skill that can be very mechanical and non-emotional. And finally, our mission is to encourage and convince every trader to become a self-directed investor and manager of their own financial future. Now let's get started with the presentation. What you see here is a normal distribution curve, and if you spend any time with me, you know that all my trade strategies and all my trading is based on probabilities. Today we're going to be talking about a strangle which goes against us, and we have to manage it as an inverted strangle, but it started out initially in that one standard deviation range. That's the big portion you see in the center, where 68.2% of the time we know that price will be contained within that range. Here's a risk graph on a short strangle. And a short strangle is simply selling an out-of-the-money call and an out-of-the-money put. In this illustration, A is represented as the out-of-money put and B is the out-of-money call. And what you can see here is the green area is the profit area, obviously. And as long as price stays within that range, in this case, that one standard deviation range, it will be a profitable trade. Once it breaks on either side of those and gets into the red, obviously, then it's a losing trade. Now, we have to also deal with time and volatility, potentially expansion and contraction. But for today's conversation, to keep it very simple, we're going to talk about the short strangle and what to do when it gets outside of its expected range, which is only going to happen probably 25% of the time. Now, what I did on April 6, 2018, I opened a short strangle on XLE. Now, XLE is the energy ETF, one of the 11 subsectors or spider sectors of the S&P. And you can see the open that day was 67, the high, the low, the close. The range was only like 60 cents or something like that. So it's a nice, beautiful, sunny day here in Naples, Florida, and I sold to open a 72.64 May 18th expiry strangle. I was able to collect $1.30, which is $130 for every one lot that I traded, less the commission, of course, of $2.30. This slide is showing you the trade detail that we went through from the initial trade, which you can see at the bottom, April 6th, the put and the call, sold the call for 57, the put for 73, which was the $1.30 or $130. And of course, that was done as one transaction. And then subsequent to that, you can see all the adjustments and rolls that we did to continue to manage this trade to profitability. So many people put on a trade and it goes against them, even if it stays within range because of expanding volatility, and they want to panic out of it. I want to show you that, in fact, trades that go against you can be managed profitably, break even, or at least a small profit. In this case, we did pretty well, as you'll see. Now, here's an illustration that I put together for you. We started out on, as I said, April 6, 2018. The original trade was a 72.64 strangle expiring in the May 18 cycle. We sold the 72 call and the 64 put and collected $130 less $2.30 in commission. Now, on April 19th, as you can see, I'll point it out to you, XLE jumped up quite a bit, about $7 a share. So I was forced to take a defensive step, and I converted this normal strangle into an inverted strangle. And what I did here, is illustrated by the blue arrow, is I simply rolled the 64 short put down to the 73 short put. So now what I've got is I'm short a 72 call and I'm short a 73 put, which makes the trade an inverted strangle because the put is higher than the call and vice versa. Now, for that roll, I was able to collect an additional $130 in premium. So at this point, I've collected about $260 in premium, plus the commission, and I'm sitting with a short 72 call and a short 73 put. On May the 7th, I rolled this exact trade, the inverted strangle, out 1 month to the June 15th expiration, and I collected $55, as you can see illustrated here. 8 days later, on May the 15th, I had to even get more aggressive. Price continued to go up, as you can see represented here in the prices, up another couple of bucks. So what I did on May the 15th, I rolled the 73 short put up to the 76 short put. So now I've got a $4 wide inverted strangle, but for that roll and for taking on that additional risk, I collected $127 in premium. So at this point, let's add it up. We got 260 and 182 was about $442 worth of premium we've collected, and we've got a $4 risk on this trade. If price lands in between these two strikes at expiration, then it'll cost us the width of the strikes to exit that trade, plus a few pennies. 9 days later, I simply added 2 long options. That was to improve the buying power, reduce the buying power requirement of the margin. Sometimes I do that when volatility expands. I can put on very inexpensive wings, as we call them. In this case, I did it for $6 plus $228 in commission. I added wings and I saved some buying power. Of course, I made it the fine risk trade, but that really wasn't the motive behind doing that. It was just to pick up buying power. Now, the very next day, I rolled, as you can see, I closed the 2 puts that I sold the previous day, and I actually tightened this spread. So I rolled, typically do not adjust the tested side, which in this case is the call side, but I had the opportunity to tighten this spread, which is always a goal of mine. So I was able to roll the 72 call up to 73, and I was able to roll the 76 put down to 75. So now I've got a 75, 73 inverted strangle. I collected $6 for doing that, but even more importantly, I reduced the width of that, this width between the strikes, between the short strikes. So now if the trade would expire within those 2 short strikes, it only cost me about $2 to exit that trade. I've collected far more of that in premium. 6 weeks later, on July the 11th, I just simply rolled the same 75, 73 strangle out, just another month, the same strike, 75, 73, and at that time I collected $67, as you can see. A day later, I put long wings on again to pick up buying power, reduce the margin requirement. Just simply did that, and I rolled it out at that time to August, and for that trade I collected $71. A month later, on August 13th, I finally just closed the 2 short strikes. I let the wings just expire. They were worthless. There's no value, no bid on those, so I just let them expire. I closed this trade out for $260. So the net result of all this is I was in the trade for 129 days, not the normal 21 that we like to be in, or 22 or something like that. I was in 129 days, but I actually had collected or accumulated $320 in premium. That was my profit, less $16.47 in the commission that we paid. So we turned an original $130 trade that we'd like to take off for 50%, collect and take it off for $65, and it went against us, went wildly against us, but we were able to manage it very mechanically and non-emotionally, and resulted in a fairly nice profit on the trade. Now, if this type of trading and trade management is of any interest to you, I do have the OptionsMeister Gold membership, and it's a small group of like-minded investors. I'm not going to read you the bullet points. You certainly can do that, but we have a live trading room and a private Skype chat where I post all the trades, all the exits, and all the adjustments in real time. If you have an interest in it, join the OptionsMeister Facebook options trading group, which is a free group. And you can reach out to me there, or reach out to me on through that in Skype Messenger, or feel free to contact me on my phone, email, or my Skype John_A_FLA. And if you have some time, stop by the optionsmeister.com website. I do have a free level, the bronze level, and you'll have access to a bunch of content and stuff that I think you'll find of value to you. Well, I hope you've enjoyed the presentation today. If you have any questions, again, don't hesitate to reach out to me. I want to wish you good luck and great trading.